starting your route to retirement.
As always, thank you for listening to the Guided Retirement Show. We know there's thousands of podcasts out there, and we appreciate you listening to ours. I'm Dean Barber, founder and CEO of Barber Financial Group. This episode, we're going to be talking with Brad Kasper. Brad is president of LSA Portfolio Analytics, and Brad also has a degree in economics. And Brad's going to be getting really technical with us on a few things as it comes to investment theory, economic theory, and what a person should be really looking for, listening to, in order to understand what's going on, not just in the economy, but how what's going on in the economy affects the marketplace. I hope you enjoy this episode. Joining us, Brad Kasper. And so Brad, President and CFO of LSA Portfolio Analytics. I'm going to have you explain a little bit more about what that is. You also do your own, what you call FAN Radio, FANN, as a financial advisor news network, and your main focus is on helping financial advisors build portfolios for their clients, and that is your entire business, right?
That's correct.
All right, so you have about 440 advisors that you work with all across the country, helping them construct portfolios for their clients, and your firm, LSA Portfolio Analytics, is influencing about $8.5 billion in assets.
That's correct. So we are a institutional research firm based here in Kansas City. We work with independent advisors across the country to help with the construction of portfolios on a number of platforms: mutual funds, ETFs, 401ks, 403bs, really anything with an investable chassis. We help advisors with how to search, how to allocate portfolios, and then most importantly, how to monitor over time and make good, important investment decisions for strategies.
All right, so how long have you been doing this now?
So we launched back in 2005.
Okay.
So we're coming up on our 15-year number here.
All right, so that's awesome. I mean, that's quite an influence. $8.5 billion in assets under influence in 15 years. That's a big accomplishment. Congratulations.
Well, thank you. And it's been an interesting path, to say the least. You know, when we established our business model, we acknowledged that cost is always an issue, and so we really wanted to address our solutions in a very different way than what this industry has seen in the past. So we actually work directly with the advisors. We don't tie into client assets. We don't charge additional expense ratios. It's a unique way for advisors to tie into research that I think is extremely appropriate for clients, and especially if you're focused on controlling the expense side of that equation when investing.
You know, we'll get into that expense side of thing at some point during our discussion, but I want to go, and I want to start here, Brad, with your background. You went to the University of Maryland. You got a degree in economics, and that's been kind of your love. You like kind of digging in and understand why things work the way that they work, and the mechanics behind why investments work the way they work, and how different things in the political environment or economic environment affect different types of investments. And so talk a little bit about that whole process, and not too great a detail, but give us a little bit of a flavor of what it is that you look at.
Yeah, so my wife is a therapist. She describes me as a functioning introvert, which means I probably do better in front of numbers and reading research and things along those lines than people, but I can also be personable, as well as hopefully I've been able to demonstrate over the last 14 years of knowing you. That said, when I started in this business, I gravitated to the investment side of it. Why? Again, there's a lot of numbers, a lot of math that I could sink my teeth into. And what we were trying to do at the time was really establish a defined process. We weren't trying to get cute with anything. We were simply stepping in and saying, where does the math work out to where we could build solid strategies that fit a goal? And I know that we're going to be talking about different types of goals down here in a few minutes. But we really wanted to establish strategies that resonated for that goal purpose. And so I leverage my background in economics, the understanding of what's happening in the markets, to help influence the development of portfolios. I leverage my background in math because this is a business that is driven by statistics. There's so many stats that we could probably do a 4-hour segment on those alone. And I had a passion for it. And so we started developing processes around those stats, around what's happening in the markets, to really build out what we define as meaningful strategies that we think resonate well, especially for those investors that are in retirement or pretty darn close to it.
Why is it different for somebody that's in retirement or close to it? I know the answer to that, but I want to hear from someone with a background in economics and someone who really, I'll call it, geeks out on the numbers and the statistics. Why is it different in retirement or close to retirement than, say, somebody in their 20s or 30s?
Well, I think that's the most important question that you have to start with is, what's your objective? I deal in an industry where there's a lot of really smart people, a lot of egos engaged. Everybody's puffing their chest talking about, oh, my strategy did this, my strategy did that. And at the end of the day, that's all great. You can take a step back and listen to it. But if you didn't ask the question of the investor for that specific strategy is, what's your goal of that strategy? Then I think your entire premise of what you built that portfolio for is wrong.
But so many people, Brad, they think that, well, investing is simple. The whole goal is just make money.
Yeah, go outpace the S&P 500. And in 15 plus years of doing this, I've never seen the S&P 500 be the determining factor of success within a financial plan. Yet that's what our industry our investors seem to think our industry gauges all of this by. And I think that's crazy. Now, if I'm a younger investor, maybe the S&P 500 or the risk of the S&P 500 might make sense. Why?
Well, hang on a second. I got to throw something out at you here. So let's say that we take the peak of the market in the fall of 2007 to the trough of the market in March of 2009, where the S&P 500, an unmanaged index, which you can't really invest directly in, there's some funds that kind of mirror it, but that index was down by 57%. So are you telling me that a person says, I want to beat that loss of 57%, so if I manage to only lose 55%, I'm a winner?
Well, trust me, there's a number of people in our industry that would define that as success. If that's what their benchmark was, and if that was the goal of the investor was to simply outpace the S&P 500, I guess you could use that as a barometer of success. But let's think about that for a minute. If I'm older, in retirement or darn close to it, the disruption of 57% drawdown in your account is detrimental. For me,
that'd be almost impossible to recover from.
Yeah, and the simple math that I like to use is if I were in an investment that lost 50%, so I had $100,000, now my account's worth $50,000, and the question I always ask of any investor is, how much do I need to make on that $50,000 to get back to my $100,000? And what do you think the answer is 8 out of 10 times?
50%.
50% what I just lost, but that's not the reality. So the miracle of compounding works when you're growing assets.
When you have positive returns. When your account of $100,000 goes down to $50,000, I now have to make 100% return to get back to where I started. And we use that as a gauge of, this is what I want to be as an investor, is just keeping pace with what the S&P 500 is doing. But it's used time and time again through multiple market cycles. Why? Because the S&P 500 is going to post a couple of really positive years. We get in this mindset that we're missing out on something, so we start chasing those types of returns. And again, I take a step back to what the previous statement was. If we don't understand what the goal of the investor is, your strategy is rendered worthless. So in your role as president and CFO of LSA Portfolio Analytics, where you are helping 440 independent financial advisors around the country construct portfolios for their clients, is part of your job then to help that advisor understand these realities? Or does the advisor in all cases understand it? Or are there cases where the advisor gets caught up in that emotion too and says, well, if I'm not keeping pace with a particular index, my client's going to fire me?
Yeah, so majority of my conversations are direct with financial advisors across the country. And one of the things that I pride ourselves on is we've always taken kind of this educational approach to the way that we talk about how we build strategies, why we believe they're relevant And so, yeah, we're constantly having conversation with financial advisors so that they have the language to be able to communicate through different market cycles, the importance of focusing on what the strategy was built to do to hit a specific goal or target. And so I think as soon as you start to deviate away from that educational process, you've rendered yourself to the markets and you're at a whim just chasing wherever the markets happen to be blowing at that point in time.
Yeah, and it's been really interesting since the advent of the ETF or the index type funds that are designed to track or mirror an index. People tend to look at that. That's what I should be doing this, right? That's what I should be doing. But the reality is, you started talking a little bit ago about this whole concept of how it's different when you approach retirement, or it's different when you're in retirement. And the whole purpose of the Guided Retirement Show here is to really help people understand why things and rules change as you approach retirement and as you enter into retirement. So we got off on a little bit of a sidebar there, but bring us back to why the focus for your group is geared so much around that person in that pre-retirement or retirement age range.
So let's take ourselves back to the initial phase that investors go through, the accumulation phase, right? You get out of college, you start working, you build your family, you try to save as much as you can, because why? There's a goal down the road that you've established enough wealth that you can take a step back and live off of that wealth without working for the rest of your life.
We call it financial independence.
Financial independence. So in accumulation phase, one of the topics that I think this industry leans on quite heavily is the idea that you have time on your side, which means if you want to go get the best returns out there, the industry is going to paint this picture of go be 100% in equities or something that's ultra aggressive, something like the S&P 500. And if you happen to be subject to a period like 2000, 2001, and 2, where the S&P dropped in a very similar fashion to what we saw again in the Great Recession of 2007 through 2009, that you have time on your side to recover those losses. So in accumulation phase, they're really leaning on time as is your friend. And to be candid with you, after doing this for so many years, I think there's some truth to that. If you can stomach being down some of those 50% drawdowns that the S&P has yielded, then yes, the research, the data suggests that over time you'll be able to recoup that and provide greater growth. Why? Because more often than not, we're in a growth pattern within the U.S. equity markets. But here's where it gets difficult. Is at some point you're going to transition out of this accumulation phase into distribution phase. And that's a whole new, that's opening a Pandora's box at that point, right? Because what disrupts investors in distribution phase is the lack of time. And so if I'm overexposed to those equity exposures that we've been taught to utilize in my 401k, just go get the growth for 30 plus years. If I follow that same example and all of a sudden my account that has appreciated to $1 million and as an example dropped to $500,000 in 2007 through 2009, I think that might have an impact on what you can draw out of that over the lifetime of your retirement days, and that's meaningful.
And so your idea then in the investing just before retirement, say 5 to 10 years out, or in retirement, is there has to be some sort of protection mechanism or some sort of offset for those equity positions. You're not saying time the market or something like that. You're just saying build a portfolio that can take you through different cycles and then understand the likely outcome of that type of a portfolio through all market cycles. Is that what you're saying?
It is, but I want to take a step back first, because even in accumulation phase, we still believe in the power of diversity. And we think that you can still be an aggressive investor and get equities, but you can spread that risk of equities between domestic and internationals. You can look at emerging markets. You can look at other sectors that might help diversify the return patterns over time to give you an experience where you're still not trying to avoid the big participation in the massive drawdowns, right? And we'll talk more about why we think protect first and promote growth second is always the most important way to think about investing. But as I start to get older, that portfolio, that diversified strategy needs to continue to morph into something that is, it continues to focus more on that preservation of principal side of the equation than the growth side. Because again, it's the disruption late in retirement that can blow up a financial plan very quickly.
Okay, but I don't think it's just that. So I've been a financial advisor now for 32 years. I've known you for almost 15 years, and I think you do a fabulous job of what you do. But I think that there's a lot more what I'll call behavioral finance, psychology of the individual investor that really is the problem here, and not just the strategy itself. Because you can look at different strategies, and you can have one strategy that, say, is let's call it a moderate growth strategy, where you might have a 70% equity exposure and a 30% fixed income exposure, and you can then compare that to a strategy that is just the opposite, 70% fixed income, 30% growth or equity positions. Run that through a financial planning program, and you can see that the probability on the end of the plan of that person being able to do what they want to do is really the same with the 70% equities or the 70% fixed income. It's opposite, right? So you can make it work both ways. However, what I would argue, Brad, and what I want you to talk about here is that the portfolio that's 70% equities can have more substantial losses than the portfolio that's 70% fixed income. And even though knowing intuitively and from a mathematical-based decision and knowing all the statistics and all the facts that, hey, that drawdown in that 70% portfolio, yes, it hurts, but it's not going to impact your ability to do all the stuff you want to do. You can say that to somebody, but the reality is how they feel when it comes to the losses that they experience won't allow them to actually carry that through the other side. And I think that's where the real danger comes in, is that people they'll bail, right? They just say, I can't take the pain anymore, so they jump out, and then they have no plan for reentry, and so those losses become permanent. And I think that's the most devastating piece. And so to me, that's where the investing in retirement is so different. It's the psychology of it more than it is the underlying math. Because I can look at those two strategies and say, hey, either one of these things is going to work. You're going to be successful. And we look at statistics, and we look at time, and we look at back testing, and we look at taking you through the Great Recession, the '87 market crash, the 2001 dot-com bubble, the financial crisis in Russia when they had their Russian bond crisis. I mean, we can go back into the energy crisis. We can test all these different time frames, say, look, you know what? Yeah, you had some losses, but just give it time. It's going to be okay. But psychologically, I think people have a real problem with that.
Yeah, you're having a full discussion around what we spend a lot of time on, which is behavioral finance. How do we respond to the way that our investments are behaving? And to your point, this can be a double-edged sword, right? So let's go back into our 2008 as an example. If I'm in that accumulation phase because I sat across from a financial advisor that said, you have time on your side, you can do this, just be a little bit more aggressive, go participate in the markets. And then all of a sudden, I get halfway through 2008 and I've watched my account lose 20%, 30%. And then all of a sudden, what do? I throw my arms up in the air and say, I give up. I can't take this anymore.
Right, because they don't know where the end is.
Yeah, so what emotion are we drawing on there, right? When we get that big pullback,
it's fear.
We're talking about fear. And in this case, when that capitulation happens, I typically see investors go to very secure assets, right? Their CD rates, the money markets, the short-term fixed income. I don't care what it is, just get me the heck out of the way of the equity markets. Well, what ends up happening? They stomach a lot of the loss, as you had just mentioned, and then they're sitting on the sidelines when that dead cat bounce happens in March of 2019 and the markets roar back 20-some-odd% in a single year. And that disrupts this overall return profile.
You said 2019, you meant 2009.
2009, thank you. So let's go back to your original premise here. If I'm in a 70-30 or a 30-70, the ability for those to work for your financial plan it requires the investor to have the mindset and the ability to live through those market cycles, to avoid those fear trades, to also avoid what we're seeing a lot of right now, right? Markets are at very lofty levels here now in 2019, and we're seeing people at the tail end really chasing that return because why? Now you're talking about the greed side of the equation. This is this fear of missing out on returns. And where's it coming from? Maybe you're playing golf and somebody in your foursome talked about this tremendous stock portfolio that's up 20 some odd percent, whatever it happens to be. We start to feel that we're missing out on that. But again, all of this is great conversation, but what does it circle back to is the original thing that we talked about. If I don't understand what my goal is as an investor, then I can't make the appropriate decisions from an investment strategy, from an allocation, or my ability to tolerate the up and down market participation in different types of market movements.
All right, so let's help our listeners here. And let's talk about realities that are present when it comes to investing, because this whole fear side of things, Brad, I believe, stems from a lack of understanding of what people own. All right. So if we broke it down into a simple company, right? Let's use a company that everybody would recognize. Procter & Gamble would be a perfect example, right? Well, what does Procter & Gamble do?
Right.
They sell and produce and manufacture household products, right? Soap, shampoo, on and on. They had a Folgers coffee. So all these different things. So if Procter & Gamble stock drops by 50%, does that mean that all of a sudden Procter & Gamble is only selling 50% as much as what they were the year before, the week before, the day before? Does it mean that their earnings are off by 50%? Did they lose 50% of their clientele? Did they lose 50% of their workforce? What really happened, and why in the heck would a stock like Procter & Gamble go down by 50%? I'm just using that one company as an example because I think people can relate. So from an economic standpoint, explain why that can happen. And because if people don't understand why that can happen, then that's where their fear of this thing is never going to end, and all of a sudden I'm going to wind up with nothing comes in.
That's right. So take a step back. As an investor, if we're going to step into some type of an investment, we have to understand what that investment vehicle looks like. In this case, we're talking about stock that gets issued on some of the broad exchanges out there. And when I purchase that stock, I'm buying it at a price that the market is deeming as fair value. And we're buying that stock with the thought that over time, we think that there's going to be growth within that corporation. And then you go through a market cycle where economic data impacts them to some degree. Maybe it impacts their bottom line so they can't generate as much revenue. So what ends up happening, these corporations will introduce on a quarterly basis earnings reports. And those earnings reports simply go out to everybody, and it's a bill of health. How am I doing? How's the company doing? And when I look at pockets like '08, where you saw a number of companies down over 50%, it's not that all of a sudden overnight their workforce was cut in half, or that all of a sudden they're not selling they're selling 50% less of their goods or products. But there's an impact that's happening from an economic perspective that is driving the consumer, us, right? We're the ones buying the shampoo. We're the ones buying the household products. And that pattern starts to change, and it impacts the bottom line, the revenue side of their equation.
So what causes the stock price to drop so much? Is it a buy side, a sell side bias? Is it more people want to sell than want to buy? What's the root cause here?
Market sentiment. I mean, you have to be able to translate economic data, translate earnings, and come up with the idea that says, here's where the markets are deeming as fair value. And as an investor, we either ride through that and say, I think Procter & Gamble has the ability to recover on the backside of that. I see the strength. This is just mispricing of the markets. Or you sit there and say, no, I want nothing to do with that. I see the writing on the wall. I see the pain points. But we're talking about a single stock. There's so many different investments that we can step into.
So can we relate this to our listeners? Let's relate it to the real estate market, because I think that's something that everybody can really get a grip on is real estate. And let's just talk about home ownership as an example, all right? So in 2000 and let's see, it was the Fair Housing Act, which I believe was put into place in the late 90s, that basically encouraged banks and lending institutions to pretty much loan money to everybody. So it became very simple to get a home loan. There was this mad rush, and you had, new home sales, existing home sales, all just going through the roof. Therefore, you had this, massive rush of buyers. So it was a seller's market. People were able to ask a premium for their house. They were seeing their prices of their house go up by 10, 12, 15% a year, depending upon the area of the United States you live in. And then all of a sudden, we had this financial crisis. It was a lending crisis. There was too much money loaned to people that shouldn't have borrowed it. They start defaulting on their loans. There were all the derivatives and credit default swaps and things that are way too complicated to talk about here. But then all of a sudden, somebody woke up a year later and they said, well, that house that I purchased in Florida for $500,000 is now being appraised for $250,000, right? So in that particular example, you could either say that the $250,000 isn't really reflective of what that house is worth, or that individual really overpaid for that house. So that same concept applies to stocks, right? If you paid $100 for a Procter & Gamble stock and all of a sudden you wake up a year later and it's worth 50, is 50 really the reflective price, or did you overpay at 100? So it's understanding how companies are valued, how real estate's valued, and understanding where you are in an economic cycle before you make the decision to invest, and for what period of time are you going to invest.
Well, and I think that real estate is a fantastic example, right? We can get our minds wrapped around it. If I were going to be buying a home in that time frame, guess what? The end of 2008, early 2009, when all these appraisals on the homes were very cheap from a market perspective, created a tremendous buying opportunity.
Well, we see it now in hindsight,
Sure
but we
do.
didn't know. We didn't know, was this the end? Am I going to pay $250 for this thing, and all of a sudden I'm going to wake up in a year and it's going to be $125,000? Where's the bottom? And there's where the fear comes in, Brad.
It is, and this is an industry that we're always taught about, buying low and selling high. Right, but the way that our emotions operate is it tends to yield the opposite effect. So for people that had the foresight to step into 2008, 2009 and look at these properties and say, listen, over the next 5 years, 10 years, the valuation on that property is exponentially higher. They took advantage of buying low. But the problem is, to your point, is when you're in the midst of a financial crisis, and you're seeing your house, your stock position that's just getting crushed. When you execute on that fear trade and you release, or you get rid of that specific investment, you just realize that loss. And so you're making a statement that says that loss today is good for me because I think there's greater loss around the corner. And that's often not the case, right? I mean, how many times have we seen too many people migrate away from really solid positions, really good company names, because we just happened to go through a cycle that created so much fear that they couldn't stomach any more of the loss. The balance sheets are probably still fairly healthy of a lot of these names. The long-term outlook on some of these companies are probably very healthy. Use Apple as an example. I mean, gosh, Apple stock sat there for over a decade and didn't do anything. And then all of a sudden, it's not that the company was rendered worthless. It didn't have a good captain behind the ship. And so once you got the captain, navigating the ship, look at what Apple stock has done for investors over the last 20 years. So it's understanding that valuations matter in any type of investment that you step into.
So what should a person look at if they're going to buy, if they're going to invest? Do I look at price to earnings? And if I'm using price to earnings, do I use Shiller's CAPE ratio when I look at the price to earnings? Do I look at a price to book? Do I look at Tobin's Q ratio? I mean, there's all kinds of, if you want to look at how you value a company today, there's a half a dozen really popular valuation methods that can be used. And And the question is, what should an investor be looking at when they're thinking of investing?
So I think there's two sides to that response. One, there are so many different stats out there that investors can step into to help them make a valuation decision with how they're buying an individual stock. I'm going to be candid. I'm not a stock picker. I've seen a number of different methods work with a number of different strategists or analysts that are out there.
Right, but you understand overpriced and underpriced. So let me take it back to the real estate as an example, right? If that house in Florida that I gave an example on a few minutes ago, you paid $500,000 for, but the appraisal said it's only worth $250,000. Why would you pay $500,000 for it?
That's
okay.
Right.
So I'm trying to establish, how does a person determine what's the real value of what they're purchasing? You and I today, if I'm going to go out and buy a piece of real estate, the first thing I'm going to do is I'm going to get an appraisal and say, what's it worth, right? And it's going to be compared to other properties around of similar type, similar size, similar age, etc. We want to know, is it appraising for what I'm buying it for? That's our valuation metric on real estate. It's simple to understand. What's my valuation metric on the market? And with so many people just throwing money into their 401ks, and let's face it, what they've done in creating this situation where many people have to opt out of enrolling in their 401k, and they have this automatic enrollment, and it's throwing them into these what we'll call life cycle funds, or target date funds, or things like that. There's no possible way that the average person can understand what in the world are they buying, and what's the valuation of what they're paying for today, and is it really fair?
Yeah. It's a great question. So let me answer this very simply. I think balance sheets matter. So a price to book equation makes a whole lot more sense to me. Why? Because it gets back to the fundamentals of any business model that's out there. At the end of the day, if you were going back to your home real estate analogy here, if I were buying a home, but balance sheet was I'm spending a whole lot more on a monthly basis than I'm bringing in, I don't have the capacity to step in and buy that home. It doesn't matter what the valuation is at that point in time. We'll translate that over to the stock side of things. If a company is shelling out so much money, and maybe they're targeting growth, maybe they're targeting something for expansion, it doesn't matter. If they're shelling out more money than they're bringing in, at the end of the day, I would say that's a pretty tough equation to get your mind wrapped around, that the price of that company has the ability to grow unless these investments really pay off. So your risk starts to jump up quite a bit there. And when you take a step back and think about target dates or the life cycle funds, it's extremely challenging for any investor to step in and say, am I getting this at a good price?
But I think the whole concept there, and really the premise behind those target date funds, is to do what you said early on in this podcast, which was, as you age, you should get more defensive. Well, I think a lot of people believe that if I just use this target date fund, this target retirement date fund, that's automatically what's going to happen. Yet we saw people, Brad, in the 2008 financial crisis, the Great Recession, that owned a target date fund of 2010 that took a 37 to a 40% loss. Well, I'm sorry. If I'm 2 years out from retirement and this thing has enough exposure that I can lose 35 to 40%, that didn't really reduce the risk like I thought it was going to. And I think a lot of people got hammered by that. And for me, as a financial advisor, I think, well, what in the world were they really doing inside there? And how did that happen? And even more importantly, how does the individual investor identify that potential and be able to do something to protect themselves?
So, first of all, I think the general premise of what target dates were released for were incredible, right? Because it addressed the two things that we talked about earlier. I have a goal of retiring in 30 years. I have 30-year time horizon. Each year, I want to get more and more conservative as I get along. So the general thesis of what they put together there was phenomenal, right? Now, the problem is on execution side of it. Do we really understand what we're owning as we're getting more conservative the closer that we got? And I think your 2010 example of the target date funds performance through the 2008 timeframe is prime, right? Here are people, investors that are 2 years away from retirement and experiencing a 30 some odd % drawdown within their portfolio. well, gosh, if I'm investing in a target date, I would think that I'm fairly conservative if I only have 2 years left on this slow migration out of kind of that equity to fixed, or that more aggressive to more conservative. And the reality of all of this is, when you peel back the onion of some of these products that are out there, what you find is you were overexposed, or maybe had greater risks that were associated because you were overextended in maybe equities, domestic, international. Maybe in your fixed income side of things, you were too focused because there's so many different opportunities that would exist there. And I think that was detrimental to a lot of investors, and kind of put some... really tarnished a lot of the target date funds.
All right, so how do we find this data? What analytical tools do you use to understand what's in there? So, because what you're doing really is you're advising advisors, and you're the guy that you say is more comfortable with math than you are with people, right? Give me a computer and give me the numbers to crunch, and I'm there. You're the functioning introvert that your therapist wife says. But so you're in there in the numbers. What are you looking at, and where do you get your information?
Well, there's so many tools. I mean, I've often argued that over the last 10 years, the access to information is just incredible, and almost to a detriment, because a lot of times we let that information drive decisions that are impacting our day-to-day investing. And I don't think that that's the best response to the way that you digest information. But there's, simple tools out there. Heck, people could go to Yahoo Finance and grab a quote on almost any stock name that's out there.
Yeah, but the quote's not going to do anything, especially on a target date fund. It's going to tell me what the price is that day, but that's meaningless. What does it own?
So where do I go a step further? Well, Morningstar has some access points that I could go in there and get some high-level information. But if you really want to look underneath that hood, you start to have to pay money for these systems. At LSA, it's almost embarrassing how many different systems that we utilize, because we're constantly in search of new information. We use firms like the Informa Zephyr, which is a tremendous data feed and allows us to dive down into information and statistics that are more relevant when you're starting to construct portfolios. Because we're talking about very simple, a single stock or a single asset class like real estate. And what I hope investors get out of this, or listeners get out of this program, is there's a lot more to just saying, hey, I need these couple of names and I'm going to head out there and do well. We think about the universe of in always bring it back to how do we diversify appropriately. Zephyr does a tremendous job of helping from an allocation perspective and deep dive into investments like ETFs or mutual funds and active managers. And that's a whole nother conversation of active versus passive. But it allows us to screen through that universe and grab statistics that you're just not going to find in a lot of the open platforms.
All right. So the idea here, if you haven't picked up on it yet, is what Brad's really saying is, all right, you got to know what you're doing. You got to know what you're buying. Don't go into something blindly. Make sure that as you're approaching retirement, you're consciously reducing your risk. Make sure that you understand what exposure you have to risk, know how to measure it, know what to expect. Make sure that your emotions are in check. And, if you can follow those fundamental things, then you have a lot better chance of success. And, Brad, I want to do another podcast with you, and in this next podcast I really want to address the different theories around risk in a portfolio or in an individual security or a fund. We'll discuss modern portfolio theory, a Nobel Prize winning formula put out by Harry Markowitz. There's another one that you referenced, Gaussian mathematics, and then there's this other one that's called a fat tail analysis, which typically only large institutional investors will pay any attention to. All these things are designed to help the investor understand the probability of outcomes over certain periods of time with their underlying investment, and what's the potential risk and potential loss over any period of time. So do you think you want to get into that on another podcast?
I think it'd be extremely meaningful for people to know that the depth of research of what's available out there and the impact that it can have in terms of portfolio construction and the way that you think about investing. We took very broad brushstrokes in this segment, right? We're identifying a single position or a stock, and we're trying to say, here's ways of looking at a single investment. But the average investor that carries, 10, 15 different types of positions, different types of asset classes, you're talking about a very detailed type of portfolio solution that requires, I would say, some very strong know-how with research and data. And I think some of the math that you had referenced, I would love to talk about it, even though it's deep in the weeds, but it's always fun for me.
We'll get into it, and we'll try to bring it down to the level where the individual investor can understand it. Before we finish this show, I want to remind everybody that the Guided Retirement Show is all about you being able to live your one best financial life, really take that trip into retirement and think of that as the longest vacation you're ever going to take. Imagine you're, going to spend a month in Europe. What are you going to do? Just go over there and wander around the streets? Yeah, you can get there on your own. Yeah, you can, rent a car, do whatever. But wouldn't it be better if you hired a guide, somebody that actually had been there, done that, and could show you all the places where you needed to go and see and places you should avoid? I got a great story about my mom traveling over to Europe by herself that I might pick up on in our next episode here. But the point is that you really shouldn't even have the discussion about the underlying investments until you've had the discussion with your financial planner about what your journey is going to look like. And that's what we're talking about here on the Guided Retirement Show. We'll get Brad Kasper back on here, another segment, and we'll talk about some of these mathematics. So we'll look forward to having you all join us for that. Thanks, Brad.
Thank you.
Find links to this episode's show notes and giveaways in the show description, or visit us at guidedretirementshow.com/10. And don't forget to subscribe and get notified when we release our next episode.
Investment advisory services offered through Barber Financial Group, and SEC registered investment advisor.